Trading blocs are also a potential barrier to international trade. A trading bloc is a group of countries in a geographical area, such as Europe, that have come together to protect themselves economically from countries outside of this group. They put agreements in place to allow them to trade easily with one another without any tariffs that we mentioned earlier. However, such trading blocs become barriers to international trade as it places restrictions on goods or services coming into the bloc from countries outside of that bloc and their agreement. Therefore, a trading bloc is a barrier to true international trade, as it makes the free movement of goods and services much more difficult. Examples of trading blocs are NAFTA, the EU, and APEC. Each of these has their own set of rules that benefits only those that are part of that bloc, and this is what hinders global trade. If you're not part of that trading bloc, or do not have a trade agreement with that country, then you fall into WTO rules, which is the World Trade Organization, that has a set of rules for international trade, which are much less favourable than those who are within inside these blocs. The European Union is a prime example of a trading bloc. All of the countries within the EU can trade freely with each other, which means that no tariffs are put in place on goods or services from within the bloc. This makes goods and services cheaper, which is good for both businesses that export and businesses that import within the EU. However, this is not good at all for countries outside of the EU, as they have to set up trade agreements with the bloc as a whole, and the EU also has put tariffs on goods and services from outside of the bloc, which again acts as a barrier to international trade. Like tariffs, trading blocs have their advantages and disadvantages. The advantages mainly come for those inside the bloc. The disadvantages of trading blocs, and the most obvious one, is importing and exporting to countries outside of the bloc is much more expensive. Another disadvantage is that usually you can only be part of one trading bloc, and these are usually based on geographical location. As you saw in the examples, NAFTA is in North America, APEC is in Asia, the EU is in Europe, and they all have their own trading blocs. The final disadvantage is that you can lose your ability to negotiate your own trade deals with countries outside of the bloc, as these are normally negotiated by the bloc as a whole. Most of the benefits we've covered, but the most obvious one is free trade in terms of no tariffs when trading with countries that are inside that bloc. The benefits of trading blocs are not only tariff-free goods, but also, in a lot of cases, the free movement of people, which can benefit companies who have an international presence, as they can move employees around internationally without the long wait times and costs associated with different countries' visa requirements. Finally, it can help foster strong relationships between countries within the blocs, as they have a shared interest in the economic stability of those countries, as they are all intertwined much more than they were before. All in all, despite tariffs and trading blocs being a potential barrier to international trade, they do play a major role in how business is conducted internationally and the relationships countries have with one another. Whether this is for the better or for the worse is yet to be seen.